Fantastic. Okay, let me kick this off. We've had essentially a big shift in DeFi where rather than having users going to essentially managing their own positions or going into static position managers such as Yearn Vault, we've gone into more essentially delegating that responsibility to active managers. So we have essentially curators running vaults for different strategies. Particularly the USD-based or stablecoin strategies have been the ones that seem to have the most growth. We've had earlier today Machina presenting their solution, but essentially every single liquid fund in existence has created their own vault infrastructure. So my first question is, what do you think that is and what benefits or issues you see with this trend? We can go sequentially. If anyone wants to speak over each other, please feel free.
I can start. I think, yeah, sure. So I think stablecoins obviously are the building block of the vault ecosystem, as you said. I think of stablecoins as the fundamental unit of on-chain credit. They are rehypothecated T-bills and money market funds that are then lent out against other credit instruments. So basically, you have people doing looping trades and rehypothecating credit all over the place, and it turns out that doing that on-chain it's actually pretty good. Like, it generally works, and you can squeeze a lot of juice out of those trades and make them really efficient. Where it gets hairy is when you're getting too cute with your LTVs and you are not necessarily pricing the risk of the underlying asset. Let's say it's a private credit fund that, you know, on the surface looks all fine and dandy, but maybe is not the quality asset that you thought it was. And I think that's where the part that I love about the vault model that's taken DeFi by storm is you do have professional risk managers that are curating these vaults.
Yeah. So first of all, I apologize if I say something stupid. For once, I blame it on jet lag. Vaults are really taken by storm. I think the best way to summarize it is every day we're straying a bit further from God, because what's happening is we started with T-bills, which are basically HQLA, so very liquid asset, and we're progressively adding into the backing more and more esoteric collateral, more and more riskier things, which is not bad per se, but it's exactly what happened in 2008. The difference is that it's more transparent. You can have an idea of what's in it. But it's basically the quality of these assets. Can we even call them stablecoins? I think it's disingenuous. And legally speaking, we actually can't call these stablecoins. What's actually happening is we're going further onto the risk curve because there's more and more offer. And because people in DeFi like to chase yield, which is normal, we're starting to have a growth of the risk again, of the risk curve that's being pushed further and further back. And it means that the most important thing you should look for when you're actually looking at a vault is basically the risk management process. It can be either internal, like Aave is doing, for example, or external, like the Morpho model is. But at some point, if no one is doing the risk management, it's going to go to zero very fast.
So there's a lot of different risk. I think Luke touched on one of them. You got, of course, the risk that Gauntlet, for instance, would look at the risk curator of this vault. But there are also new risks that are coming with a new type of asset that are coming in. So we have private credit, private funds, private equity. There'll be more and more of those coming from also staking and restaking and royalty. So that's the interesting part of Vault, right? You have all those different type of investment that become available, and you can have strategy with Vault of Vault that will just adapt. But one of the Vault that will have to be looked at for all those that involve RWA, real world asset, is the actual credit risk of the underlying token.
Yeah, I mean, I think this kind of highlights a growing problem over the last few years. And essentially, a few years ago, right, you had some stable coins. You're like, oh, let me just lend them out on Aave. And you kind of understood where the yield was coming from. You had an idea of the types of risk that you were taking, right? You know, Aave could get hacked, or, you know, Aave could maybe onboard a collateral asset that is not very high quality, right, and could potentially, have such exposure, right, that maybe they could become insolvent, right? Not to say, right, that Aave is bad or that would happen, right? But as a user, right, choosing to earn yield, right, you could kind of understand the source of the yield and contextualize this risk. What I think we're seeing now with these vault strategies is that, like, as yields have kind of compressed, people are chasing the yields and stepping out on the risk curve, and I don't think they're necessarily understanding what's happening under the hood, right? And the risk-adjusted return may actually be quite poor. And the issue here, right, is that you don't see this in a degradation of performance. You see this play out as a binary event, right? Everything is fine, everything is fine, everything is fine, and then one day, right, like it's completely worthless, right? And so, I'm not going to say that we need more regulation, we need standards, right? Of course, those elements will be introduced, but I don't see a lot of self-policing in the ecosystem right now. It's very much a growth at all costs type of mentality, and that's a bit concerning.
But we need the standards. That's the whole point. What you're describing is just human behavior. People don't do the work, and that's why you have intermediaries. For those who were there when we started DeFi, the whole point was we're going to do finance without intermediaries. And I think no one is saying that anymore because we realized it's a terrible idea. Because you're never going to reach non-financially savvy, like non-institutional people, because they're always going to do the mistake and get wrecked. That's why even the most decentralized protocols, things like liquidity, you can even set someone else to manage your interest rates. You need intermediaries. You need someone who's going to build a standard. You need an SMP that's going to say, this is a bad idea. You should not put money into this.
So, no, Luke, do you want to say it?
I wanted to shout out very quickly Credora Network, and I know S&P Global actually invested in these guys, but I think last week they released their platform to individual DeFi users, and you can go on there and you can look at every Morpho vault, every stablecoin, and see like a TradFi equivalent credit rating for that opportunity, and you can also see like a probability of default or a probability of significant loss for that vault. And I think some of those numbers, if they were more widely circulated and known, would kind of blow people's minds. Like a lot of the stable coins that people look at as money good, like safe, sleep at night risk, are effectively junk rated debt masquerading as a $1-for-$1.
Something we had a problem like 1 or 2 years ago, especially around standards and credit rating, was there's a new asset and a new stablecoin every day. How do you follow and how do you rate this, right? Now we have LLMs. So we could actually have like an SMP Credora model that could actually rate this. Would never be perfect, but it's better than nothing. Please do it.
Thanks, and thanks for the shout out on Credora. So yes, so we started to create product in the field, right? So we created, I mentioned it before, a product specifically for stablecoin, and so we assess the risk of some of the biggest name, and some others, and some got better scores than others. It's freely available. You can ping me or just Google stablecoin S&P Global. You'll probably find the stablecoin stability assessment. Now, we're always looking at what type of new product we could create and are needed. So we've been asked to do all type of stuff, right? Like, can you assess the risk of wallet, of token, of stablecoin? We did it, of staking operators. And now there's more and more conversation around vaults and how could vaults be rated. But the idea here would be to focus maybe not only, but a lot on the overall credit risk, right? When you look at rating or scoring from S&P, you're always looking at something that tell you in general probability of default, which is basically what is the risk you don't get your money back. And then you have to look at all the risks that are involved in that. So the risk is not the same based on the protocol you use, the blockchain you're in, but also, yes, all the underlying tokenized asset that there'll be. My belief and our belief is that, and again, opinion on my own, I believe in the tokenization of everything. So I think everything will eventually be tokenized. There's a lot of appetite for yield that are not correlated to what is in TradFi. So when you start to have, staking yield in Vault, restaking, royalty, stuff that can be also intangibles, you'll have more and more interesting use cases in vaults and in tokenized asset. But then you'll need this visibility on risk. So yes, I'm thinking about product around that.
So clearly, risk is currently mispriced in DeFi. I think that's the nicest way of saying it. Yeah.
And I think right now we talked about risk quantification, which is important, but there's also the opposite, the counterpart, which is risk mitigation. If you look at a traditional bank, the reason why people continuously deposit capital is the bank have a balance sheet. If they have a problem and they lose, the first loss is on the balance sheet. Then they have a surplus buffer, theoretically, that's also counted in the balance sheet. That's mandatory from the Basel III requirements. Then they have an equity buffer, also mandatory from Basel III requirements. And then they're insured by the state because they have a banking license. How many protocols have this much protections? The answer is zero, because even the ones who have a surplus buffer usually are not at 2.5% of cash bounce. Maybe Aave, but then again, I think it's arguable.
You're forgetting about Sky. The ultimate.
It's not 2.5%. At some point it was capped, but you're right, because it's not necessary. 2.5% is overkill, right? These are things we're trying to incorporate in our protocol, but one, you need a lot of capital to be able to do it. And two, I think the question that people are not asking themselves enough, when you look at the banking regulation, I'm sorry, I'm going back a lot to this because it's not just bad things. Most of the collaterals are always what they call HQLA, which is basically cash deposits, treasury bills, and reverse repo, right? So how do we build crypto-native HQLA? Otherwise, we're always going to do centralized things because these are the safest assets. And that's what we haven't done today. And that's my white whale.
But the reason why, it exists in TradFi is also regulation. And so regulation is coming, right? So we got MiCA, I touched on that this morning, but the regulation coming in the United States is a game changer. So we have it for stablecoin. But then the next one they have is a clarity bill, right? The market structuring, which might address a lot of those aspects. Maybe not in the first version, I don't know. But through this regulation that will be done, which at the end of the day is to, with the target, at least, of protecting, you'll have those mechanisms that will be put in place. And again, it depends who you're targeting, right? Are you targeting retail or are you targeting institutions? They won't have the same risk profile or understanding of risk.
So I think you started answering my question, which is what solutions we have in the market of this. So I want to talk to you, Luke, about on the insurance side of things, how difficult it is to get people to actually accept the correct pricing of assets. And I'll jump to Nick with the implementation of oracles, which we've seen is not as easy as people think it is.
Exactly. So this is what we're building at Cork. So like I said earlier, on-chain credit default swaps, and it's relevant for individual stablecoins, but it's also relevant for vaults. So if you think about a yield-bearing stablecoin that people take for granted, it's a one-for-one pegged asset. We've seen tons of depeg events in crypto over the years. And so Cork is a way for anyone to take a view on the probability of default, significant loss, a depeg event, what have you, and have a transparent risk pricing for that asset. There's going to be a pegged asset, and then there's going to be an underlying collateral asset or a redemption asset that gets posted by the liquidity providers who are effectively providing the cover for that trade. So they're going to earn premiums from the insurance or protection that they're selling. And then what we like to do is we like to use a yield-bearing stable as the collateral asset to make it more capital efficient. So that could be like USYC from Circle. It could be staked USDS. Depends on what the LPs want to do. And then for vaults, we'll do a similar type of trade, but it's more about helping risk curators and vault managers to have certainty of backstop liquidity or a buffer of liquidity in the event that there's a run on the vault. So if you have, you're running a loan book, that's your vault, and you have 20 to 30% in liquid assets that you can use to service redemptions at any given time. If you have half of your depositors click the withdraw button at once, you're not going to be able to service those withdrawals. And so having a Cork market in place and owning a number of swaps allows you to take your vault token plus the swap, go to the Cork market and redeem at any time for a liquid underlying that you can then come back and service those redemptions with. And so you think about the game theory of that. If your users know that there's a Cork market, they know that it's that much less likely for there to be a run on that vault. And then you actually reduce the likelihood that that happens. You reduce the risk of losses or of that liquidity leading to problems with your vault.
Nice. So now, Nick, let me get your take on. So the last few, I'd say, not even necessarily like this asset allocation vaults, but a lot more the credit vaults of like Morph and Euler have had issues where we can call them hacks, but in general has been misconfiguration or misspecifications of oracles that have led to, let's say, less than desired outcomes.
Yeah, I mean, I think oracles were playing on easy mode for a number of years. Right? Crypto assets are crypto native, right? There were native kind of liquidity solutions, and it was quite apparent, right, where volume was happening, how much liquidity there was, right, and it was really easy to kind of aggregate all of these sources together to construct a reasonable pricing model. With these vault strategies and also touching on tokenized assets, right, it's becoming much more esoteric, and I think the Oracle space is kind of going through a coming of age kind of process now, right? We've seen what happens when it's done inappropriately, right? And it's a function of garbage in, garbage out, right? I think we got kind of like a teaser of this, right, when it came to the LSTs and the LRTs, right, where we weren't necessarily pricing them based off of the market price, but more on the underlying, right, which we knew ultimately had some redeemability guarantees, or at least like eventual redeemability guarantees, right? Now with the extension into private credit, this becomes a much more esoteric and difficult problem, right? You can, price these things, but there are extra kind of risk considerations where price is not necessarily the only identifier, right? You want to use, right, when assessing risk, and this is kind of what I alluded to earlier in my presentation of, the more esoteric these things become, the more you need data infrastructure that is reporting on more than just price. Because if we're waiting on, for example, a rating agency to downgrade, it's already too late, right? There's a race condition here, and you might be the last one out the door, right?
And that's a good point. One of the things that we know will happen is at least two. One is ratings and scoring will come on chain.
Absolutely.
And they'll have to become more real time.
I think some part we haven't covered yet in the panel, which is around optimizing. It's optimizing yield. It's also optimizing the whole stack. DeFi only works if it's better than its counterpart. What we have to understand is purely on the banking industry. The banking industry operates at a very large leverage, something that would look absolutely crazy in crypto. Traditional funds operate on average at a 7x leverage. Banks operate at something like 12 to 13x, and they're allowed to go, depending on the size of the bank, I think something around 30. If I'm not saying... So we are playing DeFi on easy mode. You're 100% right. It's going to get 10x the leverage. Lending protocols are going to make 10 times more money, which is great if you own part of it or if you're building one. But it also means we're going to have to automate a lot of the credit rating. We're going to have to automate a lot of the processes. and we're going to have to automate a lot of the risk understanding. When you're building a risk stablecoin vault, it means that you're basically going to have to be extremely risk averse or extremely good at managing risk, and there's going to be no in between. Something you can look at if you look at the most successful companies today in crypto, Tether, Circle, Coinbase, they have one point in common: they take very little risk, or they're able to hedge it out or pass the storm, because some of them did take risk, but they were able to push it in under the rug before it got back to them. So the more each risk you take is basically bad debt that at some point you're going to have to fix. It's what you mentioned before. I think this problem is called the Thanksgiving turkey, which is you look at the life expectancy of a turkey and you look how many turkeys actually die for Thanksgiving, right? Exactly. So the whole point is, one of my good friends had his protocol hacked not once, not twice, but 3 times. Most people quit at the first hack. They're actually still paying back the bad debt. They've been doing that for almost 2 years. Kudos to them. And when you talk to him, he used to be very hand-wavy about risk management. Now he tells you it's not about how do I reduce the risk. It's how do I accept that at some point we're going to lose money and we need to minimize the consequences of this. And this is why I talked before about surplus buffer, about all of these. This is why things like Cork are very important, because optimizing yield is not going to be just how do I get the best APR on that specific block. It's how do I get the best average yield over the next 10 years? Because if you want to be there on the long term, there's going to be huge opportunities in the industry, but you have to survive. And survive means managing the risk.
No, I think risk management is the name of the game, and it's woefully inadequate at the moment in DeFi, right? And it may be a case of we learn by failing, right? And I would not be surprised, right, if any of what we think of like the blue chip, right, DeFi lenders, if one of them were to just blow up, right, just because they have too much exposure and they didn't do their homework. It's still very early days, and we're gonna crawl, walk, run, but we can't just go straight to running.
Well, actually, bring this back to, I think you guys also mentioned the introduction of private credit into DeFi, as well as, let's say, more DeFi owned practices of having building on like money Legos. I think my question here would be more on, do you think you can run a protocol that successfully merges both of them at the same time? Or you're basically going to have a situation where the DeFi experts are going to mess up on the private credit, and then the TradFi experts are going to mess up on the DeFi side of things? And maybe, Charles, I'll put you on the spot because I am interested in bringing, from your perspective on SMP, how do you guys see how DeFi has been operating until now?
Yeah, so it's been an evolution for sure. Like when I started this team in 2022, I remember speaking with a lot of protocol many that do not exist anymore, and bring the idea of looking at the risk of this and that. And there was not a crazy interest in 2022, 2021. But it's been evolving, of course, since. Now, to your question specifically, there's something that is often said is DeFi is not reinventing everything. There's a lot of things that exist in TradFi that are very similar. There are some new things, but the tools that already exist to manage the risk in TradFi can also be used in this field. So I think that what Cork is doing is very interesting. For the risk of private credit, there are tools and ratings, etc. for that. Now, also, what need to be real time is not necessarily everything. When you have Vault, like they probably will have to have a risk evaluation that is real time. But if the risk evaluation of the T-bill or the tokenized money market fund that are part of the overall strategy is, less with a lower, a bigger latency, then it's not an issue. So I think there's definitely a path forward. The good thing is that people now care about it. Just the fact that we have panels speaking about risk now. Again, go back to 2020, the DeFi summer, you didn't have that.
I mean, most of the people here maybe with the exception of Cork, would not even be talking, maybe no S&P 2, would not be talking about risk a year ago. It's because there's an evolution, the fact that we have marketplaces that create an intermediary to manage this. And it's not just internal teams who are doing it. It creates new market opportunities on one end, and the other is there's a lot of demand for a more sophisticated product, not just a T-bill wrapper. One, because some people, not a lot unfortunately, realize that T-bills is not a great backing, especially in the current geopolitical context. But the second one is people want more yield. So all of this is to enable to access more capital and more basically rewards. The problem is the cost of the risk management worth the extra reward? And I think only time will tell.
And just quickly, like if you want, like most people, most protocol are interested, not all, but are interested in getting the money from the institution on chain. I mean, we've been hearing about the institution are coming 2017 and 2000, but now they are for real. And risk management and how is the risk being looked at is a very important thing that they'll look at.
Yeah, I actually wanted to touch on that as well and just shout out Maple Finance, which is where I worked for the past couple of years and was there in 2022 when we lost $60-odd million in our loan book. And I was actually pretty adamant throughout that period that was somewhat okay. Like it wasn't a crazy default rate for a high yield, high risk, uncollateralized crypto loan book. We did like $3 billion of originations up until that point. And yeah, we lost some money, but the default rate was in line with the credit that was being created out of the Maple engine at the time. And if you look at Maple now, they have like $2.5 billion of TVL. They're getting allocations from Cantor Fitzgerald, from Sky through the Spark liquidity layer. So the largest allocators in DeFi, and then in TradFi, you have legitimate Wall Street banks allocating dollars into Maple for crypto-backed lending to crypto counterparties. I mean, that's a very real success story that, like, I sat on the investment committee at Maple for the last year plus, and like we didn't shy away from taking risks. We were very calculated in the risks that we took, and ultimately that led to where the protocol is today and the success that they've seen.
No, I mean, I absolutely echo that sentiment. I was at Maker, or Sky, formerly known as MakerDAO, at the time, right? And I can tell you out of the first 5 or so instances into kind of like private credit, we had 4 defaults, right? We had like an 80% default rate. And, I think, we're not necessarily naive, but inexperienced. We recognized how inexperienced we were, right, and made sure that the exposure, right, we had was, if we kind of assumed it would all default, and we wanted to be fine, right, in terms of solvency. But no, I think still, we were quite, we considered ourselves smart people, right? We were one of the original, DeFi OGs, and I think we got a little bit too all up in our own ego, right? And this stuff is difficult, and I do worry though about, right, not going through this crawl, walk, run, right, type of flow rather, and just, someone just full sends, $500 million or something, right? And it's a binary kind of a insolvency event if that, it's too big to fail in that sense, right? One of the other things I'm concerned about is, without getting too directional about monetary policy, right? But eventually, monetary policy will come down. And those kind of juicy T-bill yields that people have gotten used to, you could even say have gotten drunk on, right, are going to disappear. And they're going to step out on that risk curve, and you'll see kind of an explosion of private credit, right? And the risks that those users will be taking on are, a completely different ball game to the what is the current meta, right? Of just, okay, it's T-bills, it's issued by, I don't know, by BlackRock, or it's issued by Ondo, right? It's issued by Superstate, I feel like every point I make comes back to, like, we need to be careful.
You're saying something super important. It's a race against time. Right now, we're at over $250 billion of stablecoins. It's the greatest vector of the United States dollar ever. 79% of all stablecoins are backed by T-bills. So that's 78% of the backing is just T-bills. And at some point, right, the pendulum is going to come back, and we're going to go more into private credit, because this is always what happens when you look at the allocation of traditional financiers. The problem in my mind is that tokenized private credit right now, the best comparison you can do is basically with crowdfunding. Crowdfunding is for people who can't raise funds with venture capital. Is tokenized private credit? It's an honest question. I'd love to have your opinion here. Is it for people who can't raise on traditional markets? And if so, why can't they raise on traditional markets?
How many ICO projects are still around?
No, so you're talking about ICO. I'm going even a step further. Think about Web2 companies crowdfunding.
Yes, it's a total adverse selection problem. You're getting assets that can't get financed off-chain, and they're just coming on-chain looking for liquidity. That's how it's been for the past number of years. I mean, hopefully, over the longer term, you start to see the better assets coming on-chain as the capital markets get deeper and more liquid, and there are real benefits to be had from doing that. But up until this point, that hasn't been the case. I also just wanted to push back on, and I think it's an interesting point around, like, monetary policy and easing. The beauty of crypto yields up until this point has been, when monetary policy eases, then crypto prices rip, and then people want to borrow against their crypto, and then the on-chain risk-free rate, if you can call it that, of Aave or Morpho or wherever, those vanilla money market lending protocols, those rates get very attractive, and that's also priced off of where basis is at. So, I mean, do those trades go away? Do those get crowded? Is there, like, more capital allocated on-chain today so that if crypto's ripping, those rates aren't, 500 basis points wide to T-bills at any given point in time? I don't know.
Just on the quality of the asset, I think we'll see more and more interesting assets. So there's private credit, there's private equity. You saw that Apollo tokenized several funds, at least one. I think they're doing another one. So I think TradFi is coming through this angle also, and you'll have more and more interesting investing opportunity for looking for the liquidity you have in DeFi. And it's always a chicken and a egg issue, right? Do you have the product first? Do you have the liquidity first? But now you got evolution on both sides, and you see where it's going.
Is there more liquidity? Because I consider crypto to be the second biggest liquidity market in the world after the American market. I hope it's a fair assessment. The problem I see today with this is basically that all of this thing, what's the argument for private credit to come on-chain outside of we can't find funds?
Access. It's when you speak with KKR and Hamilton Lane and all that they did for tokenization in general, getting in one of their funds is really painful for a high net worth and not even accessible to the average person. So there is a real access component. But just the way they did it, when if you're in one of their funds, it's really painful to get in. Then you want to get in another one, it's painful again. Now, when you were in their tokenization platform, you could move from one to the other after doing it just once. So there is an access angle, an accessibility angle to, well, you cannot easily get to invest in an Apollo fund just like that. Now you'll have the vault to do that. And the liquidity, so there's a lot of fintechs that are looking at vaults, Morpho-like and Centrifuge, etc. And what they're interested in is the yield that they can get in DeFi. So as they'll get in, and you can imagine just custodians, etc. And also you have more and more, let's say, shops that have clients with a lot of Bitcoin, they're all looking for some type of yield. So you have this demand for yield and solutions that are being built on chain. So you got the yield from staking, etc. So there's a lot of different yield that they are trying to provide to their customers through vaults.
The last one I think is really important as well is just it should be lower cost for the issuer. Because if you think about all the human beings who have to sit there and punch in the cash flows of the coupon payments from those companies that are getting paid out to the lenders, that should all just be programmatic.
All right, guys, we're going to wrap up. Thank you for the conversation. Thanks for all the panelists and everyone here coming to listen to us. Have a good day.